Americans are digging themselves into a deep financial hole, approaching $1 trillion in credit card debt.
Everything is just overall more expensive. Groceries, gas, just the cost of living.
People's wallets are stretched thin due to inflation, high housing costs, and other expenditures.
The worst credit crisis in our lifetime has already begun, with banks facing losses bigger than during the Great Recession of 2008. American consumers are going to be deeply hurt by it too. From now on, getting loans and accruing credit card debt is going to cost you even more. Last week, after reporting earnings, several major banks announced they will no longer lend money at the same rates they have been in recent years. They're going to be more wary about who they lend to, how much they lend, and the terms of what they lend. With the number of bad loans rapidly surging and the decline of the commercial real estate market threatening to trigger a wave of defaults, many financial institutions are at risk of collapsing. That's why they're now taking drastic measures to prevent even bigger losses from happening in the months ahead. However, considering the current outlook for debt delinquencies and defaults, particularly as more shoppers and businesses turn to credit to stay afloat, many of these institutions are sitting on thin ice, and they're likely to sink before the end of the year. That's what analysts with the Federal Reserve of New York predicted in a new blog post. Notably, the credit card market is starting to show its cracks as more Americans fall into financial hardship. Credit cards are the most prevalent form of household debt and will continue to become even more widespread in the coming months, they wrote. Since 2019, more than 70 million new credit card accounts were opened in the U.S., and in the second quarter, total credit card debt surged above $1 trillion for the first time ever. To make things worse, interest rate hikes overlapped with consumers' higher spending, outpacing their income increases and further deteriorating their financial health. Now that we just entered the fourth quarter, the average credit card interest rate jumped to a shocking all-time record of 24.45%. Some cards, retail store cards in particular, charge more than 30%, as revealed by Ted Rossman, an industry analyst for creditcards.com. Those massive rates are responsible for sinking 22% of credit card users in the U.S. deeper into debt each month, Clever Real Estate reported. This is just one of a series of worrying findings from a new survey conducted by the firm. Researchers noted that this year, Americans report spending 30% of their take-home pay on their credit card bills. In fact, between January and September, U.S. cardholders paid $163.89 billion in credit card interest and fees. That's up from $120 billion in 2020. In other words, purchasing with credit cards has never been so expensive, and financial advisors say it will become even costlier in the next few months and into 2024. As bad as things have been for cardholders for the last year or so, it's probably going to get worse before it gets better, said Matt Schultz, chief credit analyst at LendingTree, during an interview with CNBC. Life is so expensive in 2023, he stressed, and it's not going to get any cheaper anytime soon. So, if you're planning to finance a big purchase only when conditions improve, and only when interest rates go down, well, you may have to wait for a lot longer than you're probably thinking. During a meeting last weekend, Federal Governor Michelle W. Bowman said that additional rate increases will likely be needed to get inflation on a path down to the FOMC's 2% target. The central bank also changed the forecast for the next year. The Fed now expects its benchmark federal funds rate to close out 2024 at an effective rate of 5.1%, which is higher than its June forecast of 4.6%. This means financing a car or a wedding and getting virtually any type of loan will become harder for most folks out there. Those already struggling to cover credit card payments or other loans should avoid taking on more debt in 2024, said Eric Croak, certified financial planner and president of Croak Capital. Instead, focus on paying down high-interest debt if you can. Not all debt is created equal, and credit card debt is by far the worst, he emphasized. Unfortunately, that ship has already sailed for many credit card holders. Clever Real Estate also found that less than half of Americans believe they will be able to pay off all of their credit card debt at some point in the next year. Meanwhile, 28% believe they will be able to pay off their debt within 5 years. 11% believe they will be able to pay off their debt within 10 years, and 6% believe they will never pay it off. Data shows that 47% of Americans have not been debt-free since 2018, 14% have not been debt-free since 2013, 11% have not been debt-free since 2008, and 15% have not been debt-free since before 2003. Moreover, 53% of cardholders say they've reached their credit card limit at some point, and 29% admit that they max out their credit card every month. The average person is spending more on their card too. According to official estimates, American households owe on average $10,170 in credit card debt. Monthly credit card spending has now reached $1,506 for the average American, but the average millennial is spending even more, $2,410 each month. The debt they're accumulating month after month is making it more difficult for them to achieve long-term goals to afford short-term necessities. About 37% of card users admitted their credit card debt is preventing them from living the life they want. This sort of debt is especially disruptive for those who want to buy a home, an important wealth-building milestone that younger adults are already struggling to save for. Roughly 22% of that group said credit card debt has prevented them from purchasing a home, leaving many to pay high rent prices without the benefit of building equity. Home ownership isn't the only priority Americans sacrifice to pay down credit card debt and to make ends meet. 47% said their debt has prevented them from building emergency savings. A similar share, 39%, said it has prevented them from saving for retirement. At a time when consumers are paying more for goods and services, they need access to a credit line to cover the difference. Clever's researchers noted that 2 in 3 Americans said inflation is partially responsible for their credit card debt. Nearly 48% of respondents said they depend on their credit cards for essential living expenses like food, like housing, and like energy. At the same time, the number of people missing payments is going through the roof. Once a consumer falls behind on scheduled payments, getting out of credit card debt is rarely a quick process. For example, with today's credit card interest rates, a person making minimum payments on a $3,000 debt would need almost 10 years to pay off the principal, while accruing an added $4,000 in interest, according to Mary E. Hansen, an economics professor at American University. In the past year, 43% of Americans have missed at least one credit card payment. The most common reason for missing one payment was simply forgetting, 36%. Tied with paying for groceries, also at 36%, according to the survey. The worrying thing right now is that for the first time since the pandemic, there has recently been an increase in the amount of credit card users entering delinquency, meaning that people are having a harder time paying off their debt, Hansen added. Right now, 5.08% of credit card balances are in serious delinquency, or at least 90 days past due, the Fed reported. That has marked the biggest increase since the second quarter of 2022, when the rate was at 3.52%. Compared to other debt categories this quarter, credit card balances saw the most pronounced worsening in performance, following a period of extraordinarily low delinquency rates during the pandemic, the New York Fed said. For their part, banks are signaling that will start to cut off access to loans and credit. The largest credit card issuers pointed to growing credit card losses in their Q3 earnings. Wells Fargo said that the number of delinquencies is up by 3.5% compared to a year ago, while JP Morgan Chase and Citi noted that losses grew by 1% from the previous quarter. Issuers need to be very cautious about rising credit card and loan delinquencies and defaults because they have a much bigger fish on their plate: commercial real estate. Millions of building owners that borrowed money to finance their properties are being squeezed by high interest rates and vacant offices as workers now opt to work from home. Falling demand for offices can force a wave of borrowers to default on their loans, adding pressure on banks, which are hoping to avoid selling loans at significant discounts to prevent even more financial losses. Multiple U.S. banks saw continued pain in the past quarter on delinquent commercial real estate or CRE loans in their portfolios as stress in the sector intensifies. They recorded continued provisions for credit losses and charge-offs from the previous quarter, driven by their non-performing or delinquent CRE loans. "It's gonna be really ugly," said Rebel Cole, finance professor at Florida Atlantic University. "I'm sure that banks are trying to avoid selling their worst properties because that's going to force them to take a larger write-off, and because every property that's sold becomes a comparable sale for the appraisers that value the properties." In its earnings release, Morgan Stanley noted it expects average monthly losses of $134 million due to deteriorating conditions in the commercial real estate sector. Other banks' earnings showed similar challenges facing CRE holdings. Goldman Sachs disclosed that it had reduced its exposure to office-related commercial real estate holdings by roughly 50% due to the risks of a full-blown crisis over the next several months. Bank of America reported its total non-performing commercial real estate loans, or those with at least 90 days of payments past due, increased to nearly $5 billion in the third quarter from $4.27 billion in the second quarter. On the other hand, borrowers are struggling to refinance their CRE loans as property values have sharply dropped and interest costs have soared. Some $20 billion worth of office commercial mortgage-backed securities, which bundle together individual loans, mature in 2023, according to real estate data provider TREP. Now, if property owners fail to meet their loan obligations, a wave of defaults could spark widespread bank failures. Although consumer debt alone can put small and mid-sized banks at risk, big banks that lend millions of dollars to the construction of commercial buildings are in serious danger of going under. Regulators are keeping a close eye on bank CRE risk, and credit rating firms are downgrading some of the biggest lenders due to concerns about credit risk, prompting some institutions to take action to stop the bleeding. The Federal Reserve Senior Loan Officer Opinion Survey shows banks have started to be increasingly restrictive in their lending practices, even though households and businesses are in need of additional borrowing. Considering how important credit flow is to the U.S. economy, it boosts the chances of a worsening economic downturn are also getting higher. The latest earnings reports are proof that banks have tightened lending conditions even further for all forms of borrowing through the third quarter, while demand for loans remains steady. This is not just a nightmare scenario for consumers, but for U.S. businesses too. Companies have been grappling with the rising cost of labor, energy, manufacturing, supplies, transportation, and more. Sales, on the other hand, are falling at a brisk pace. Layoffs are becoming more frequent. Demand is also slowing down across the board, choking businesses' balance sheets. It's precisely when a company has a couple of orders canceled on them, and the business goes to its local bank and asks for a line of credit to see them through, but the bank says no, that struggling businesses turn into failing businesses. There's a much higher risk of bankruptcies happening when lending conditions tighten. Simply put, if banks don't tighten lines of credit for consumers and businesses, they risk facing steeper losses and a potential failure. But if they reduce lending, they put businesses at risk of collapsing and defaulting on bank loans, which also puts them at risk of potential failure. And on top of everything else, these institutions are vulnerable to an even bigger financial blow stemming from commercial real estate. It seems that no matter what they do, at the end of the day, the outcome is gonna be disastrous for everyone.